All right. Well, one of the things about going through a fundraising process that I think is pretty important is that you have a well thought out process ahead of time that will actually save you all kinds of hardship down the road. And one of the most important things to do is to kind of get a lay of the land and say, who. There's a lot of investors out there, but the question is who is really going to be interested in investing in your space, and then specifically who are the partners at the various firms that are going to be interested. And it's key that you try and hone in on not just the firms, but the right partner and the right people at the firm, because one of the things that you'll find is that as you're talking to various people, and inevitably as you go through the process, you'll meet a variety of people at these firms. What you need to do is you need to have a champion on the inside. And if you have picked the right person and you've identified somebody that's on your side, and hopefully that person is at least a partner, if not one of the founding partners of the VC firm, then that person will help you get through a lot of hurdles. And I think one of the mistakes that a lot of people make, and a mistake that we made our first time around in raising venture capital money, is that you just call up a firm blindly and you take whatever meeting you can get. So you might end up with a situation where two associates at a particular VC firm sit in on your meeting, and for lack of a better word, the associates are basically no men. I mean, they're there to screen out deals, and you need to know that if you get through talking to the associate, all you've really accomplished is hopefully getting to talk to the partner that you should have been talking to from the beginning anyway. And one of the things that we did, even in the market as it is today, one of the things that we did is we tried to politely force the meetings to occur with at least one senior partner in the meeting, as well as any associate that might be there. And the nature of the meeting when you've got a partner there is very, very different than the nature of the meeting when you've got an associate there that's looking to poke holes. The associates, that is, are looking to poke holes in what you've got, where the partners are generally much more interested in hearing the big story, hearing about not just the technology, but about the business and where you guys are going and what the vision is, and in particular about how your customers might be responding, if hopefully you have customers at that point. The first time that we went out and raised money, as I was saying earlier, was a process where we just, having no experience, having no outside help, we just started sending business plans out to people, started calling people cold, and trying to get some meetings. And the result is that we would receive letters that said, thanks, we look at your plan, but no thanks. And it was a very, very frustrating process. And what we found months into the process is that if we brought in an outside person, and that person helped kind of walk us through the process, and lo and behold, 4 or 5 months later, the first time around, deal was closed and the money was in the bank. So when we went out to raise money this time, we started there. We went out and found somebody to help us with the business plan. We found somebody to help us with the actual pitching process, the whole organization process, preparing all the documentation. And because of that, and because of all this planning that went up front, it was a much, much smoother process. And one of the things I think that people make a mistake of is that as they go into the fundraising process, they haven't really thought through how much time it's actually going to take. And so what happens is that you start to get lost in the follow-up. I mean, you can almost think of it as being very similar to how your sales team works when trying to sell your product or service. You make a few calls, you get some response, and then the majority of the time the burden is back on you to do the follow-ups, to chase down, to get people the information, to see where the deal stands. And if you've gone and talked to 4 or 5 VCs, let's say, and you're in kind of this this initial diligence process, it can be extremely time-consuming. And in fact, as we were raising money ourselves this time around, what we found is that I was spending easily 75 or 80% of my time just dealing with this process, and this is when I had 2 outside consultants helping me manage this process. If it was just me, it would have been nearly an impossible task. And that, if it's impossible to go through the follow-up, what that means is you're slowing down your own process. Another thing that I think is very important, and a mistake that a lot of early entrepreneurs make, is is not really understanding what a term sheet is going to look like before you get in there and actually see one. And there are lots of T's and C's, and you can go to your attorneys and they will have they'll have information on what a typical term sheet looks like. But you need to be familiar with the terminology, because there's going to be things in there like liquidation preference. There's going to be things in there like stock option pools, post-funding or pre-funding. And then you have your standard, the standard elements that everybody's familiar with. What's your pre and post money valuation? And what we found is that, the first time we went out and raised money, we got what we thought was a very favorable pre-money valuation. We took that money, but what bit us on the back end is that we had actually a 7x liquidation preference, which of course means that when it comes time to liquidate the company, or there's some liquidation event, the investors receive 7 times their money back off the top before anybody gets a share. And then in this particular case, as in most cases, they get to participate with the common shareholders after the fact. And that created a situation where it seemed really good up front, but on the back end, it was very, very difficult for the founding team to actually get any kind of money out of that situation. The other thing that you have to watch is the stock option pool, and this is a very, very easy thing to overlook, I think, because what happens is that you get this term sheet and it says, your pre-money valuation is A, liquidation preferences are B, and oh, by the way, you need to have a 20 or 25% stock option pool available at the close of funding. And the logic behind it is simply that, well, you're going to need to hire people. Nobody wants to get extra dilution in that case, and so you need to have this big option pool in place. But what you're actually doing is you're protecting the investors while diluting yourself, and you need to look at it that way when you're actually creating those option pools, because what happens is you create the option pool before they invest. So you probably, if they're going to invest 50% into the company, you basically dilute yourself by 50% to create an option pool so that after they invest, there's 25% options available after the fact. And when you really look at a deal, and the investors will try and argue their way, so you don't look at a deal this way, but you need to look at it as, how much of the company do I own when the deal is all said and done? And you need to factor in, just write off the option pool. Pretend the option pool doesn't exist. If you own 30%, if you own 50%, whatever it is, if you look at it that way, it starts to bring one deal into a common line with other deals, because you'll get these things all over the map. This time around we had a deal where we needed a 25% option pool, we had a deal where we needed a 20% option pool, and we had a deal where the existing option pool that we'd already created was fine and we did not need to create an additional option pool. And while the valuation, the pre-money valuation on the last deal there, the one with no option pool, was the lowest, the actual percent of the company that the common shareholders owned after the deal was the highest, and that actually was the best deal of the 3. But it's easy, I think, to get tied up in the actual numbers that you see and say, oh, well, this is, they're valuing the company more, and I should feel good about that, and therefore I take that deal. And that's really not the way to look at it. Again, if you haven't been through the process before, I would definitely encourage you to talk to people that have been through the process, to have good attorneys that have been through the process before. And I want to emphasize that, because, again, on the first time that we went through the deal, not only did we or rather the first time that we raised money, not only did we not have experience doing it, but our attorneys really weren't familiar with working with venture capitalists, and they should have been able to pick up on a lot of these things like the 7x liquidation preference that I mentioned, and they just said, oh, looks good to me, and that bad things happen. So when we set out to raise funds, I would say we started the process about 6 months ago, and really the first few months I would not call as being active pitching in the process. It was really us getting our ducks in a row, and it was as much a strategic business planning process, perhaps more so a strategic business planning process than it was a investor pitch. And that, again, that's really important to go through that process, because as you're working through that process and debating issues about the future of the company with your internal team, these are the same issues that are going to come up when you go and pitch a VC. And the most important thing when you're going into the pitch of VC is that you have answers, you have quick answers, and you're very confident about those answers. Because you can easily start rambling on about how you're looking at all the different issues around a particular business strategy, and your team's thinking of A, B, and C, and that is not at all the answer that you want to give. What you want to give is, we're doing X, here's Y, and we're 100% committed to that. And if they have some feedback, be prepared to defend your position while at the same time listening to their feedback and trying to incorporate that. After we went through that process, which was about 3 months of the 6-month total fundraising process, if you want to look at it in that scope, is when we really started to pitch VCs. And the first thing you do is you start to create what we called e-teasers, which were essentially short email bits or short phone bits that you might give if you happen to get somebody on the phone. And it's essentially your elevator pitch. It's the 30 seconds about why I have a very interesting company, what the key points are. And again, don't focus just on the technology. The technology is important, but you're not necessarily talking to technology guys. And just because the senior engineer from Stanford University thinks that that you have a cool technology, that doesn't mean that the business guy in the VC office has any idea what you're talking about. So be prepared to talk about the market opportunity in your 30-second pitch. Be prepared to talk about the future of the company and why you're going to be able to leverage your first product and services into your future products and services. Once you get through that stage, then what we did is we had another stage, kind of additional information, a white paper about the technology, what we called a corporate fact sheet, so it listed some of our key customers, some of the key investment considerations. Again, sort of the elevator pitch, but instead of the 30-second version, think of this as the 5-minute version, something that an associate can hand to a senior partner, and they can spend 4 or 5 minutes reading through it and get an interest in the company. At that point is when you try and push for a meeting. And I mentioned earlier that one of the things that you want to do is you want to try and get a senior partner in, even on those very first meetings, whether it be on the phone or whether it be in person. It's always important to try and get a meeting in person, because you can read how somebody's paying attention to you. You can read the body English and see where you're starting to lose them or where they're really nodding in approval. And that will help you not only with that pitch, but with the future pitches as well. But again, the feedback that you get from the partners is far more important than the feedback you're going to get from the associates. And so being able to get in there, shake the partner's hand, create a relationship is going to be key moving forward. Once you've got those partners on the hook, then what you want to do is, if you're getting to that stage, what you want to do is really kind of put the pedal to the metal. It's a slow process at first. You don't just want to go out with the shotgun approach and say, okay, I'm calling every VC on my list. What you want to do is go out there, have a few meetings, get some feedback, refine the pitch, refine the elevator pitch, refine the in-person presentation, work through that process. And when you really feel that you're hitting your stride, that's when you want to put the pedal to the metal. And what early on for me was going to 1 or 2 meetings a week, maybe not even. By the end of our investment process, I was doing sometimes 2 or 3 investor pitches a day. And you really get into a good form when you're doing that. You're very, very familiar with the questions, and so long as you can keep a smile on your face and keep people's names straight, you'll be in real good shape. That whole process for us took about 3 months, which I was very, very pleased with. I honestly expected that to get to the term sheet stage, we would be looking at 5, maybe even 6 months pretty easily, as people wanted to really dig into the technology. But I really attribute the fact that we were able to accelerate the process, perhaps even cut it in half, to the fact that we really, really knew what we were talking about when we went into those presentations, and we were very, very prepared for the questions they were going to ask. Not only because we'd given the pitch, 100 times before them, but because we as a team gave the pitch to ourselves. We had our CTO come in and pitch, the non-technical people in the company on their part of the presentation and explain the technology to a layperson. And then we did the opposite. We had the marketing and sales people, pitch, their business side to the technology people. And, through that process, you may find that there's some disconnect within your own organization, and you want to try and get that all hammered out, just from a general business standpoint. but it really gives people a lot of familiarity with questions they're going to get from both sides, technical and business, and that's really key. Again, short answers, crisp answers, and 100% confidence behind what you're saying. Yeah, there's nothing to pique the interest of a potential investor like momentum, and momentum can come in a variety of different forms. It might be things that you're doing internally, customers that you're getting, press mentions that you're getting in a PR standpoint, or it might be that they're just hearing through the grapevine, oh, well, you know, VC company A is also looking at this deal, and boy, wouldn't I like to get that deal before those guys. And it's easy, as you've prepared all you've pre-made a bunch of documentation to give to the VCs. You've got your pitch, you've got your what I was calling e-teasers, you've got your elevator pitch. And it's easy to get into a mode where you're just giving that over and over again, but you have to keep in the back of your mind, how do I demonstrate momentum? And the easiest way is just to continuously update people that you're talking to, even if you think they might not have a whole lot of interest in the company. You know, if you get a new customer, send out an email, say, hey, I got this new customer, here's what they do. You know, pitch the customer on why it was such a big deal, pitch the sales guy that closed it as, hey, you know, we got this new sales guy, he's really performing, because the VCs are more than anything, they want to look at that momentum, they want to look at the team, and any opportunity you have to pitch the team, the sales guy that did something, the engineer that just added the new feature, you know, mention the engineer, mention the new feature and how it's going to affect the company moving forward, and continue to show positive progress, because the VCs know that the investment process is very, very time consuming, and if you're able to kind of overcome the fact that you're spending who knows how much time out there pitching VCs and trying to raise money for your company. If you can overcome that by showing great things happening on the business side, presumably with limited resources, because you obviously want more resources, that's why you're out raising money. If you can show that, you can really help to accelerate the process. And you know, when you do get VCs interested, you know, you don't want to be out there pitching one VC against another. You don't want to say, oh, well, this venture capital company offered me X, Y, and Z. But what you do want to do is make everyone aware of where you are in the process. For one thing, it will help you because, again, it's showing outside interest will get other people interested. It always does. But you also want to be fair to the VCs, and they will respect you if you're completely honest and say, hey, well, we're expecting another firm to move into a term sheet stage, or we're expecting another firm to have a second or third meeting with us. If you guys are interested, we would be very interested in getting to that stage with you as well. And that gives them the opportunity to say, yes, we're very interested, or no, we're not. And that, for you, that can save a lot of time, because there will be situations where a VC may have been, you know, almost humoring you to the point where they may have been doing competitive research for another company in their portfolio. They may, you know, it may have been a new associate that was simply interested in that space, and as you show momentum and you're completely honest with them, they will, in general, be honest with you as well, and they'll say, well, look, I don't think we can get to that stage in this period of time that you're talking about, but there'll be others that say, okay, we were going to have you come in and present to the partnership next month, but let's have you come in next week, and that can really benefit you down the road. And again, you know, good ways to show momentum are, you know, through customers and sales, through press releases, even just press releases that you have on the website. I mean, they can be expensive to try and pitch a press release to the active journalist community, but just putting press releases on the site, you know, circulating those press releases to everybody that you're talking to, just keeps your name in front of them. Again, think about pitching VCs as being the same as pitching customers. You know, they are essentially a customer. You're selling them a piece of your company. It's not that you're just begging for money. You are, in fact, selling them a piece of the company, and you want to approach it as you would approach any other big sale. Show them momentum. Show them the team is, you know, solid in the company. Show them that you know what you're talking about, and you'll get through the process much, much smoother. In terms of due diligence, there are really three stages to due diligence. There's if you have a technology company, there's technical due diligence, and in most cases, the VCs are going to bring in outside technical people that they know and trust to evaluate your technology, especially if it's a venture capital company that has no prior experience in your particular space. So you have to expect that. You have to be able to have your technical people give a presentation, not just if you're the CEO and you're out there giving presentations all the time, that's fine, you're very much in stride, but at some point your engineers are going to have to talk to other engineers, are going to have to talk to other business people, and having them up to speed, having them practice that pitch a few times is very important. And as you're going through the due diligence process, keep in the back of your mind that at every stage you are in essence pitching that VC again on your company, because they could pull the plug at any time. And it's not just that they are looking for a bunch of information to jot down in their notebook. If you give the technology presentation during due diligence and they don't like it, the whole deal could be off. And it's important that you approach it that way. Likewise, there's going to be likely some business due diligence, maybe some more in-depth competitive analysis than came out in the first few meetings. Have to be prepared to talk to any of your competitors. Of course, as always, prepared to talk about the future of the company and the products and services that you're going to offer. And then there's going to be a giant pile of legal due diligence. And the most important thing here, I think, is A, make sure you've got good attorneys up front before you ever start the fundraising process. And B, if there's one thing that you can take away from what I'm saying right here, is keep good records from day one within the organization. When we raised money the first time at my first company, we didn't do that. And the company had been around for 3 or 4 years before we actually raised venture capital money. And what happens is shortly after you sign a term sheet, the attorneys of the VCs are going to send you a big list, 3-4 pages long, of all of the documentation they want you to produce. Everything from stock option agreements to any business contract that you've ever signed, to accounting, GAAP-approved accounting practices for all of your books, and they'll want records of everything. And that first time around, for me personally, represented about a month of my life spent digging through boxes trying to find all of the documentation, sitting in the attorney's office, which of course costs God only knows what, to spend a month with our attorneys to sort through all of these boxes of documentation and pull out the information that the VCs wanted. You can go to your attorneys right now, because they're often on the other side of the VC deal, and get a list before you're even pitching. Get a list of what the VCs will be looking for from a legal standpoint when you get a term sheet. You can then start keeping good corporate records from that day. Your attorneys will help you do that. They can keep the records on site there. And when that sheet comes from the VC after a term sheet, when that sheet of here are the 100 items that we need for our legal due diligence process, you can have it almost immediately. Not only is that going to make it a lot easier on you, but that just shows a very professional image to the VC. You basically keep the process moving. It shows that you were completely on top of your game from day one. And believe me, it is a whole lot easier to do a little bit of legal work as you're moving through the growth of your company than it is to try and play catch up after the fact, because you'll never remember every contract that happened. You'll never remember every little thing that got signed. And when that's the case, that always leaves a loophole for a VC to come back and say, well, you didn't disclose this or you didn't disclose that down the road. And I like to err to the side of overwhelm them with information. If you signed a contract with the water company to come bring water for the employees on a weekly basis, put that in the documentation. Put everything in the documentation. Let them sort through what they want or don't want, but then you can never be held accountable for not disclosing something that turns out to be very important down the road. It's very, very difficult to say what you can expect from a term sheet as you're just heading into the process, and the markets change all the time. But I think if you're talking to good VCs, what you should expect is a fairly plain vanilla deal. If you get a term sheet back and it has a 5x or a 7x liquidation preference, or it has that you need a 30+% option pool available after funding, or there are often things in there like revesting of shares. So in some cases, the founding team may own some or all of their shares already, and the VCs may want you to revest those shares. A reasonable request, but the details may be unreasonable. If they want you to revest those shares over a 5-year period and you've been working at the company for 5 years, that's not reasonable. And you should be looking at these things as red flags to say, maybe this VC isn't who we should be talking to, because if they're putting those things into your deal now, who knows what's going to happen down the road. What you should be looking for is a much more plain vanilla deal. What I think is reasonable is a liquidation preference of 1 to 3x. I think is fair depending on the particular circumstances. I would tend to err to the 1x side you'll run into what they call participating preferred stock, which means that in a liquidation event, they're going to get 1 to 3x their money back and then participate as though they owned common stock the whole time. The other thing that if you're lucky, you might run into is a situation where it's not participating preferred. So what that means is a VC would have the option to either take 1 to 3x their money out in a liquidation situation or convert their shares to common and just participate with the common shareholders. If you're talking about a low, a 1x participating preferred situation, I think that's fair. I mean, that's not unlike even what you might invest in the public stock market if you bought preferred stock. But again, there are red flags if somebody's looking for something, much bigger than that. You have to watch it because everybody thinks about, and what the VCs will pitch you on is the big win. Well, would you rather own 5% of a $1 billion company or 20% of a $1 company? But remember that a lot of liquidation options are going to occur in the mid-range, in the range where the liquidation preferences that the VCs pull out are a big deal. So if let's say you raise $5 million and they have a 2x liquidation preference, you then sell the company for $20 million, the VC is going to pull out $10 million to start and then participate. So it's as though you had sold the company for $10 million. Well, the thing to do is think about if the VCs didn't think that if they didn't think that middle road, the low end liquidation was that big of a possibility, they wouldn't care about the liquidation preference at all. When they think it's a big possibility is when that's a much more important thing. So just be thinking about that and think about what you want as a plain deal, something that you hopefully as a good business person would think was fair if you were just dealing with another company. If you were investing your money, what would you expect out? And I personally would expect that as an investor, I have certain rights to get my money out in a bad situation. But other than that, I'm believing in the company. I'm putting my money in, and you should look for that, that kind of feedback from the VCs. Thing to look at in any kind of term sheet is, the board makeup after the investment, and in Series A investments in particular, this is critical. What can easily happen is that you end up in a situation where before you know it, it turns out the VC has complete control of your board. In a typical situation, what I've seen is that the common shareholders will have at least one board seat, hopefully more, that they control. Often the CEO has a board seat, and the investors will then have one or more board seats that they control. So when you're looking at a term sheet, let's say you get a term sheet where the common shareholders get 2 board seats, the investors get 2 board seats, and the CEO gets a board seat. And somewhere in the dialogue, it turns out that the VC wants to bring in a new CEO. In that situation now, you've got 5 board seats, the CEO that the VC brought in, and 2 investor board seats. And you can easily end up in a situation where you no longer control the future of your company. And it's not a situation. It's never a situation at first, unless you've been duped, that the VCs are out to seize control of your company. But you have to always think about what happens when the going gets rough, and understand that while in general the intentions of the VC are in fact aligned with the intentions of the management team, that is not always 100% the case. There may be situations inside of the VC firm completely out of your scope of what you're doing at the company that influence how they're going to vote on certain board decisions. If they're in a situation where you are in a fund and they are looking to liquidate that fund and close it out, then that VC is likely to err to the side of taking an M&A offer or shutting down the company even, where you as the management team might not want to do that at all. If they control the board, it's essentially out of your hands. Likewise, there might be a situation where you want to sell the company, but they block it, and that can happen even if you own more shares. Oftentimes in a funding event, the investors that take a preferred stock have certain preferred rights. A very common right to see is that the preferred must vote in favor of any M&A transaction. it's going to be hard to get around that, but it is something to keep in mind, especially as you're looking at all of the other T's and C's within a deal. If the preferred can block an M&A transaction and they also control more of the board, what can you do? You can always, if you control the board, at least try and force them into into going the way that management wants to go, because you do have more board votes, and things can get ugly, but you have to do what's right for the company. And if you don't have that control, it can be a big problem. So as you're looking at a term sheet as a whole, all of these factors need to come into play. Just because somebody's offering you more money at a higher valuation does not mean that is the best term sheet by any means. Because if the difference between taking $4 million or $5 million is that big of a deal, then you've probably done something wrong. I mean, you need to be looking at the future. You need to say, what happens if I sell the company for $30 million? Run the numbers, see what it looks like. What happens if I sell the company for $100 million? Run the numbers and see what it looks like. Likewise, run through some scenarios with your team. What happens if Microsoft is my next big competitor? What does the board do? If you're in a situation where you don't control the board, the VCs lose interest in the company because you've got a new unforeseen competitor, bad things can happen, even though you and the team might be committed to to fighting the good fight and getting out there and running things. So always keep in mind who you're getting into bed with. You are essentially getting married to the VCs. I saw a statistic once that said that the typical VC company relationship lasts longer than the average marriage in America. So just keep that in mind, that you do need to see eye to eye with these guys and try and I emphasize try and maintain a certain control for the management team within the company.